Welcome to Focus on Fuels, brought to you by StoneX. Your hosts are Trevor McClanahan, Risk Manager, and Alex Hodes, Director of Market Strategy from the StoneX Energy Desk. Alex and Trevor help fleet managers, fuel buyers, and energy procurement specialists gain control of fuel costs, boost margins, and keep their businesses competitive. Join them for another deep dive into the volatile energy markets.
Remember that the trading of derivatives such as futures, options, and over-the-counter products or swaps may not be suitable for all investors. Derivatives trading involves substantial risk of loss. Past results are not necessarily indicative of future results.
Welcome back to Focus on Fuels. I'm Trevor McClanahan. I'm here with Alex Hodes to give you guys another update as we get into the holiday season here. How's it been going, Alex? Been pretty good. Been traveling a bit, but been staying pretty active. So, and it seems like the markets have kind of picked up a little bit as well. We've seen kind of a lot more sideways price action past previous couple weeks, but since we last spoke, I think diesel prices have really fallen quite a bit, along with diesel refining crack spreads as well. Do you want to kind of touch on that a little bit?
Yeah, absolutely. So, like you said, the whole complex has been fallen as of recently. The last 2 weeks, WTI has fallen off quite a bit, and really the big story has been, diesel and refineries coming back online, and diesel prices falling off with them. So that's been kind of dragging the complex down, as with all that refinery capacity coming online has really, drug things down dramatically. And we've seen that coming with the European and U.S. refineries really coming out of maintenance in the fall, which has driven down refined products pricing a lot. And then obviously just a big demand dip as well coming out of ag season. So, that's been the story as of recently on the fundamental side, but a lot of geopolitical stuff that's come along with that. So we'll definitely dive into that today. But like you said, let's focus on diesel right now and just give a quick update. What is your perspective? We've seen the spreads really flatten out, so that time curves have flattened out as a result of all this product coming back online and hitting the market. And that's been that's the main, it's a big driver of just the flat price as well. So now we're in these, you can look out in the curve and we're getting to where you can almost buy diesel almost below $2 now. And we can view that as, in the last 5 years, that's been a huge bargain. So what is your thoughts on that?
Yeah, I think, so, and we have kind of pointed to this in our previous discussions, was that the diesel side of the complex has really been the one that's kind of been standing firm. And when we've seen, all these expectations that crude oil supply is expected to be in surplus in 2026, really the area that's been kind of standing alone by itself has been diesel. And really that recent run up where we saw prices hit $2.60 in November. And now we're all the way down to $2.12 in the front, and today is December 19th, 2025. So, that's a matter of a month, and we sold off almost 50 cents. And when you look at it from, like you said, on the structure of the curve, we had recently that prompt spread, which really kind of tells you a lot about the supply status right on the ground and what people are really demanding. We saw that spike up along with all the the attacks on Russian refineries that coincided with some of those major European refineries that went offline. And that spread was all the way up to, what was it? Almost 8 cents, 9 cents. And then now it's essentially almost flat. So although the curve is still a bit backward, so like the further you go out, you're seeing front month is at around 212, and then you go out to the end of the year of 2026 and you're down at 205. So there's still a 7-cent spread there, but by no means is that something that we saw previously. So really the curve structure is stating, and that's telling you something as well. But yeah, one way to kind of view this, and we had just previously talked about this, is although the crack spread dropped from was over $50 per barrel, so that means that refiners in theory are making, for 1 barrel of diesel, they're making $50 profit on that almost. And you kind of can see that we're down at $30 per barrel now. So a drop of $20 per barrel, but that is still a pretty elevated time, or an elevated crack spread at this time. Like comparing that to 2024, we were down in $20 range. So I think it's still telling you something about the market, and that there is kind of a fundamental tightness in refined products, but we're seeing some of those factors just soften quite a bit. And a lot of that has to do with just kind of seasonal factors as well. And like you said, I think that $2 price in diesel is an attractive one. And that we kind of tend to see this around this December time period. Sometimes it's January, but really before we start to see huge amounts of heating demand come online. I know we've seen some cold weather, but those cold snaps in January and February are where you start to see kind of demand take off. But I think that's kind of the story on diesel right now. But going forward, what do you think about diesel? Do you think we still have some legs to run in 2026? Is this the low right now? Do we have more time to go down before the new year? What do you think? Yeah, I do think, as you kind of alluded to, I think the weather is going to be a factor there. But overall, I actually think that these builds are going to continue. We've seen a lot of refinery capacity come back online, and I think that's just going to continue. So for me, I really do think that it's going to be a hard number for us to break through once we get the front month hasn't even kind of reached that $2 range yet. So it will take a little bit of time before we potentially see that. But I actually think that we could break below that level at some point in Q1. We've seen a huge uptick in fixed forward contracting on our, from all of our customers that are locking in diesel on behalf of their customers. And, that is just due to the fact that anytime you see $2, it's been attractive in the last couple of years. I actually kind of agree. I think that you take a lot of risk away just immediately, right, when you see that $2 number, because of all the geopolitical chaos that has happened here. So a lot of the risk premium has also fallen out of the diesel price as well, due to the fact that, there's a lot of chatter about Ukraine-Russia peace deal. Whether or not we think that could happen or not, I think, the Trump administration is really pushing hard for that conflict to end. And the EU is pushing back against the administration, and not wanting to kind of give or break any give any Russian territory that's Ukraine's back. So I really am I'm on the fence on this, because I really just don't know what happens out of that conflict, and I do think that the premium has fallen off quite a bit on diesel as a result of those negotiations kind of picking up. So ultimately, I think that Q1, if everything stays the same as it is now, I do think we'll break below that $2 level. But if something sparks back into that conflict, we could be back at 220, 230 pretty quickly. So it obviously hinges on that decision and what happens there. But ultimately, there's a lot of refinery capacity that's back online now, and inventories are building right now. We've seen a couple weeks in a row now where refined products inventories have really flew up, and we've seen crude oil inventories draw some here. So it's clear as day that that's starting to happen. But where the end in sight is in this sell-off, it will be a little bit dependent on the geopolitical theater. Yeah, I agree with you there. I do think, though, something you said is kind of a good point. If we're seeing, that kick up of people kind of stepping into this market and being a buyer at this at this level, then perhaps that is one factor that's going to be kind of a stabilizing factor on the low side. So if people do see that $2 and there's kind of that psychological level, we all know that the market is definitely there's a lot of psychology that goes into it, but obviously there's also algorithms that come with that. But ultimately, I mean, a large amount of volume is traded on kind of people that are looking to hedge consumption of diesel, and so if they start to see these prices really attractive right before 2026, if they're doing budgeting and they're seeing those prices, then maybe we could see a little bit kick up in prices here, or at least some resilience before we see kind of more downward pressure, I think. But I agree with you that we're seeing, those refining builds, but there are still some bullish factors out there, I think, that could kind of, make the sell-off a little bit hesitant, especially, and this was something kind of you were pointing out to me earlier, was the PAD 1, specifically diesel inventories. Although we're in a building phase, in 2025, we're still coming at a level that was lower than where we were at in 2022 and lower where we were at in 2024 by quite a bit. So we still are, showing those tight levels inventory-wise. So anything that, and we've kind of reiterated this, is that when inventories are tight, you just see more reactiveness on the upside of if there are those spikes in demand or shortages of supply. So I think it's still right for price spikes kind of to the upside, but while the sell side might take, a little bit more time as we're seeing inventories build. So it's going to be a battle between those two factors.
Yeah, and building off that psychology that you mentioned there, with the with crude, if you look back from Liberation Day, crude oil has actually just been kind of bouncing off of that low that we've seen, the monthly low that we've seen back in April. So it went down to $55 a barrel WTI, and it never really it broke that level slightly below that, but for the most part, that was a really supportive factor, and we've seen that again here this week actually. Where it hit that level and then it just got bid up immediately afterwards. So that tells us a lot of the psychology of the market, right? And it's going to take a lot for something to break below that. I still think that, from the fundamental side, oil inventories obviously are building at a very rapid pace right now, about 2 million barrels per day, and that could even go higher in the Q1. So, with that in mind, we could still break below that, that $55 a barrel. And I think that almost, I think that could very well happen, but it's going to take something to really push that, over the edge because of that just natural support that we're seeing. Again, it goes back to what you said, the psychology of the market. People see the most recent lows that they had in the last year, and that is a really strong supporting factor. So, I think that matters a lot, and we'll have to, and going into Q1, we'll probably have to start seeing some really big builds in crude oil before we can break there.
Yeah, and one thing you'd see about crude oil levels, or crude oil market in general, just kind of shifting gears here towards crude oil, is the flatness of crude oil in comparison to the rest of the complex. So we were talking about how backward diesel is outside of the front month. Well, crude oil, WTI, that is, we're seeing basically completely flat from the front month all the way out. So January 26th contract was 56.66, and January of 2027 is 56.46. So, I mean, it's as flat as a pancake, and it is telling you something there that there's not really that concern. There's not being the front month is not really being bid up as much, and so you're not seeing any backwardation there. So that's telling you some weakness in the market structurally, and that kind of coincides with the expectations of where the EIA, IEA, and even OPEC are all expecting surpluses next year. But in my mind, there's also some hesitance there. When everybody's all on the same side of a trade, that's when you kind of got to start thinking about why that could be wrong. But one factor that has been kind of driving headlines recently has been kind of the action in Venezuela and the U.S., where the U.S. had kind of stated that they would not allow. They seized a crude oil tanker coming from Venezuela that was, I believe, to be shipped to China, and they're essentially, the U.S. is kind of putting a little bit more pressure on Venezuelan crude oil exports, but we haven't really seen loadings slow quite yet. So there's not, in my mind, it's not a huge price risk until you actually see those barrels completely stop. But Chevron's continuing to purchase, and if they're continuing to purchase, then we're going to keep seeing crude oil barrels flowing from there. So really, in order for crude oil to have some support, you got to see either a shortage of supplies, so any outages that are unexpected, or an uptick in demand. And so I think that's kind of where we're at there on crude.
Yeah, and I think that it goes back, just shifting gears slightly, just going back to the diesel pool, is, the U.S. gets a lot of, what is it, 150,000 barrels per day, roughly, from Venezuela, and they have a very heavy density to it. So I know that with that being said, they get a big diesel yield on that, and that could, and there already is a shortage of that heavier grade of crude that has the higher diesel yield. So that'll kind of exacerbate the problem of lower inventories on diesel if anything harms that, us importing that barrel.
Mm-hmm. Absolutely, and that's why there are kind of differences of which country you're seeing shortages from, how it might affect the petroleum products in general. If it's going to be kind of a heavier slate, it's going to affect distillate pool, which is kind of tighter. And then, ones when you're seeing more tightness in kind of light sweet grades, such as North Sea crude, West African crudes, or U.S. crudes, stuff like that. And that kind of just tells you another feature of kind of the oil market in general. And that's the beauty of the oil market. There's just, never-ending different factors that are going into it.
Yeah, and going back to this, the Venezuela, this is another factor that I don't think it's being talked about very much within the headline. But I do think it's definitely something to monitor, at least, is just the fact that Guyana is right next door to Venezuela, and they have a border dispute over where basically the production of those new oil fields are. Do you know that the barrels per day on this, by chance? That was on the top of your head.
I believe that it was like 900,000 barrels per day.
Right.
Recently.
So as this conflict grows, or if it does grow even further, Venezuela, that might be their first. They're not going to be able to kind of, in my opinion, I'm not a military guy by any means, but I don't think that they're going to be able to do much, outside of, or at least against the U.S. But Guyana is they're right next door to them. It's a lot easier for them to kind of ran things up against Guyana. So that might be more of their target, and trying to keep that territory that they still think that they is there. Goes back to a long treaty a long time ago that they're disputing. So that might be a little bit more of the risk side of things, that we need to monitor. For me, I'm still not. I think that the Russian-Ukraine thing is a little bit more of the top of the list as far as what kind of happens next in crude oil. But the Venezuelan thing is something to monitor, definitely. And I really think that the major factor there is the Guyanan barrel, and kind of what happened going forward. That might be a little longer term, but I mean, things are heating up pretty quick in that conflict.
I think it's interesting that this conflict is it seemed to have come out of left field from the U.S., from the Trump administration's we have been focused primarily on Russia, the Middle East, and now we're talking about Venezuela kind of out of the blue. I think I'm with you in that I think Russia, Ukraine, and then also something that's been kind of on the back burner, but just OPEC's expectations in 2026, if they kind of change their plans going forward. I think that's one area that needs to be observed. And I know you were stating kind of the possibility of peace in Ukraine, and that's kind of a downside risk ahead. But in my mind, I think those sides are just so far apart, and there's certain lines that both sides don't want to cross. So Ukraine doesn't want to cede any territory to Russia, while Russia, doesn't want to end the war without obtaining those regions. So it's kind of like a hard line on whether those two sides can come to an agreement. But it is, a risk going forward. And I did read about for Guyana that because Exxon controls a large portion of Guyana's crude oil production, I believe there was Exxon had some sort of defense that they were kind of bringing in to kind of prevent any potential issues between the Maduro regime and Guyana. So I think there's enough money to be made there that people will come to the defense if anything kind of heats up, and they're going to make sure that these barrels are still flowing, because that's 900,000 barrels per day is definitely a major player in the oil business now, and that's the amount of growth we've seen there in having Guyana kind of almost come from nowhere, and now is one of the major players, is just one of those sources of supply that have kind of outperformed expectations and kept crude oil prices from kind of jumping up to $70 per barrel or $80 per barrel. Just a lot of supplies on the sideline and areas of growth.
Right. I could not agree more. I do think that it almost adds a little bit more, just a layer to maybe why the Trump administration is being as aggressive as they are. Obviously, kind of the whole drug trafficking aspect of things is the headline, maybe for political reasons more so than we're protecting oil fields, because we know that's not going to ring to the American taxpayers' ear as much, considering we've spent so much time in the Middle East, and that's just kind of a little bit of a bad taste in maybe the U.S. citizens' mouth. But I do think that's a factor, right? I really do think that might be part of the strategic reason why Trump administration is getting involved so heavily in this conflict. So we don't need to probably talk about that in too much detail, but at the same time, it really does. It's a reason why why we're allocating so many resources to that region. It could be just another layer to it.
Yeah.
Going back to OPEC too, I do want to talk with you a little bit about that, because fortunately, politics is just what you have to talk about when you're talking about the oil business. I do think that the Trump administration's been very closely tied with Saudi Arabia, obviously, which is kind of the leader of OPEC. What are your thoughts on how long they want to keep this flooding the market, in quotations, even though that they say that they don't make supply decisions based off the price, but we all know at the end of the day they have bills to pay too. What is your thoughts on how long this can last, and how happy, or how long that Saudi Arabia is willing to keep the Trump administration happy?
Yeah,
keeping all this production online.
I don't know if it is an appeasement to the Trump administration, but rather it's just a strategy it seems, and this is all kind of speculative because we aren't in the minds of OPEC decision makers, but it did seem that they were kind of more protective of lower prices previously when they were kind of holding up the market by doing all those production cuts over the past couple of years. And finally, they are kind of unwinding all these production cuts. And I'd say that they've done so somewhat successfully because they've prevented the market from completely tanking in 2025 while also unwinding 2.2 million barrels per day of production. And I think they still have 1.5 to go. But I guess they have done, 2 months of that, so closer to like 1.1 million barrels per day that are still on the table on the sideline. And they put a pause on bringing those barrels back. I think that's something that if we do see kind of markets start heating up, that there again will be this kind of cap on how far prices can go, because I think OPEC will unwind those cuts whenever they feel like they could actually get away with that without completely tanking the market. So I think if you do see them kind of unwind these production cuts more in 2026, it's almost a good thing for the market, and that's meaning that we're seeing kind of a stronger demand, because I don't think they want to, tank this market, and they want to do it in kind of a structured way. And the good thing is that they've been kind of doing this from a month-to-month standpoint, so it's almost a thermometer of how the market's going. So I think now they're kind of on the sidelines, and they're like, okay, well, if we're expecting this big surplus, we don't need to add to it right now. So
do you think there's a price point, there's a breaking point for OPEC? As far again, they always say that they don't make a decision based off of what the price is. It's about what the supply and demand factors are. But for me, I do think that I do think there could be a line in the sand where they say, this is just too low for us to really gut. What do you think that number is? I know we're not in OPEC's mind, but there's got to be a number out there.
I think previously it had been kind of at $60, but now it seems like they're kind of willing to hang on and I guess theirs is kind of definitely going to be more associated to either Dubai crude or Brent crude. So you take this accordingly. But WTI wise, that was around $60 per barrel was where they seem to always kind of step in and make adjustments. But we've spent majority of 2026 2025 at prices below there almost. So I think they can stomach this $55 crude oil environment. But I do think like anywhere below that kind of $50 per barrel is something that I don't anybody could really sustain for too long. And another factor there, though, and we've kind of hit on this in the past, but with China just being able to buy strategically and them having so much storage capacity, it's just one of those things where I don't think prices can stay below like a $55 or even $50 per barrel crude level for too long of a time, because I think China will be able to buy at that level. OPEC could do some production cuts at that level. So I think there's kind of those put in the market out there.
Mm-hmm.
If there is a sell-off below that 55 and we get down to $50, I think that's a great opportunity for anybody that's looking for kind of either a consumption hedging, or just any way to kind of, if you're locking in pricing, anything below that is an extremely attractive level.
Yeah, so to go off of what you just said there, I also another put factor there is, American producers at some point they're going to start feeling the effect of these low price environment too. So like you said, the Chinese SPR refilling, OPEC at some point potentially stepping back in and saying we've had enough of this low price environment, we want to start making cuts, and then add another layer of American producers with higher break-even levels, as we've alluded to in the past, saying that this is enough. We're going to start, reducing our production numbers, which even if that's a 5% drop off for the U.S. producer, that's really, really big. Largest, just to remind everybody, largest crude oil producer in the world, 13.7 million barrels per day. So even a 5% knockoff would put us around 600,000 barrels per day, which we're sitting here talking about, the Venezuelan conflict, and that if that entire thing gets washed away, then that's a major factor, and that's 600,000 barrels per day right there. So, just watching kind of all these sensitive factors here that are really keeping the market pressure on it right now. But there's a lot of things that could, step in the way of us falling below 50 and sustaining that level for a while. So I'm with you. I think that anywhere below $55 a barrel is a good value. Even at 55, I still don't think that's terrible value. I think that we could sit kind of sideways in that range potentially in 26, but there's so many geopolitical factors on the table right now that could go away very quickly. And even though that might be the kind of the consensus outlook right now. One other thing I just wanted to add is just for anybody that is looking to fix forward contracts, maybe with your fuel distributor that you go through. If you're in the Midwest in general, or let's say like maybe the PNW, you're going to see even in like kind of the Rocky Mountain region, you'll see a very discounted price right now on diesel specifically in those regions, like what you can get diesel at right now. And then on the forward contract market, it's going to be quite a bit higher. But that is simply due to the fact that basis in those regions, so that the regional price is significantly lower because of the lack of demand, according to what, when you get to the seasonal patterns of the spring, fall, or summer, it's going to be a higher level than what you're going to see in the winter in those three regions. So keep that in mind if you are looking to fix price contract. Talk to your fuel dealer about that. They should be pretty well informed on that. But for the most part, that's a seasonal pattern that you should not expect that the really low winter price is going to persist through the entire year. That price is naturally going to inflate going into, getting outside of the winter in general. So keep that in mind. That won't stick around for forever.
Yeah, I agree there. I think those are really good points to kind of relate local physical prices to what the markets we're talking about all the time here. So there are kind of subtle differences, but that's kind of where we kind of see some of those seasonal effects as well. But I do think maybe we'll kind of wrap this up, and because I think we're kind of going back and forth of, we see what we see for 2026 in the next couple weeks and months. We're seeing, a little bit continued downward pressure, but we don't think this is a bad time to buy. We think there's still opportunities for upside price in 2026, particularly on the diesel front. I think after the turn of the year, we will kind of come on with like more of a long-term outlook of what we're expecting in 2026 in front of some of the factors to look at. But I think for now, we'll just kind of send you guys off on for Christmas holiday, and we'll kind of touch base after the new year. What do you think, Trevor?
I think that sounds great. Everybody, you guys have a Merry Christmas, Happy New Year, and we're looking forward to starting things off on 2026.
All right. Take care, guys.
Thanks. Bye.
You've been listening to the Focus on Fuels podcast with Trevor McClanahan and Alex Hodes, brought to you by StoneX, NASDAQ ticker SNEX, a global Fortune 100 financial services company with a century of commodities risk management experience. Subscribe to Focus on Fuels on your preferred podcasting platform. For insights on managing fuel and energy price volatility, and to sign up for the free StoneX Morning Energy Brief newsletter, email focusonfuels@stonex.com or visit www.stonex.com. Please feel free to rate, review, and share this episode with colleagues. Until next time.